going to let you in on a secret. So if we look over a long period of time at dividend stocks compared to other types of stocks, over long periods of time, they have actually done quite a good job at balancing volatility of risk and return. There's a class of stocks that have done even better than dividend stocks. All to say that dividend stocks can be great, very good component of a portfolio. They're not the be-all and end-all, and there are other areas that can actually be better, and certainly in the context of a diversified portfolio. Hello, everybody. This is John Lodrame, co-founder and partner here at New Harbor Financial Group. Thanks for joining me for our weekly video. Our goal in these videos is to bring data, insight, and purpose to our clients and viewers. We hope you find this video helpful, and I encourage you to subscribe to our channel. That's the best way to get alerted when new content comes out. Just hit the subscribe button down below and like this video if you feel like it's informative, and please feel free to share it with friends and colleagues who you think might find it helpful. Today's video is going to be all about dividend investing, stock dividend investing. And we get a lot of questions about this from clients and prospects alike. And it's no surprise because most of our clients have a lifetime plan to work and save and hopefully retire someday, and to create their own quote-unquote paycheck during their retirement. So it's only natural that clients are drawn to thinking about what you might call investing for income. And this is the second of a series of videos that I'll be doing on this topic. The first one I did was all about bonds, and I encourage you to take a look at that video. Got some great feedback from some of the comments on that video. Some people said it was literally the best bond explainer video they've ever seen on YouTube. I was quite humbled to see that. So first things first, let's define what a dividend is and where it comes from. There's a saying that money doesn't grow on trees, and the same can be said for dividends. Dividends don't grow on trees. So imagine a typical company has top-line revenues. Say it's a manufacturing company. They sell their product and they have revenues for the sales. But of course, most companies have costs. They've got to pay employees. They got to pay, in the case of manufacturing company, for energy and materials that go into the products that they produce. And quite simplistically, the net profits of a company are the revenues minus the costs. So hopefully we have a viable enterprise here and the company has net profits. Basically 5 basic things that can be done with net profits. One is to pay a cash dividend, to return some of that shareholders through a cash dividend. But that's not the only thing, and not all companies pay dividends. Another way of returning capital to shareholders is through buying back the company stocks. Now, there's a whole lot of controversy and frankly a lot of misconceptions about the whole concept of stock buybacks. Bottom line is they can be a very effective and very prudent and shareholder-friendly tool that a corporate CFO has in their arsenal, especially if the share prices of the company stock are what you might deem to be below intrinsic value. There is a whole host of other uses of stock buybacks that are of the more dubious kind. So for example, many companies that have incentive stock grants and things like that, they are known to perform buybacks as a way to counteract the dilution that happens when executives exercise their shares. Sometimes that's not a very good use of capital. In fact, sometimes it's downright imprudent, maybe is geared to serve the executives of the company at the expense of shareholders. But like with most things, there are good buybacks and bad buybacks. If that's something you'd like to see, the ins and outs of stock buybacks, please submit a comment. But beyond that, a company can pay down debt. One of the most prudent things a company can sometimes do is pay down debt, especially if that debt can be retired at more effective rates than what the company's paying. But of course, companies can use cash to reinvest in the company. A manufacturing company can decide to invest in plant and equipment, a new manufacturing facility, for example, at a different part of the country, perhaps, where cost of labor is lower or access to markets is closer. They can also use that cash to, in part, fund acquisitions of other companies, so inorganic growth through acquisitions. So there's a lot of things that a company CFO or board of directors can choose to do with net profits. One of those being paying a cash dividend. Now, a cash dividend or net buybacks or paying down debt are essentially 3 different ways to return cash directly to shareholders. Let's imagine a company has a share price of $100 per share, and they've decided to pay a $5 per share dividend. Well, the dividend yield on that stock is 5 divided by 100. So dividend yield is simply the dividend per share divided by the price per share. So in that case, $5 dividend on $100 price stock is a 5% yield. Now imagine that company ran into some troubles and the stock price dropped to 50, and somehow they were able to still sustain paying that $5 dividend. Well, you take 5 divided by the share price of 50, and suddenly you have a 10% dividend yield. Sounds great, right? Double what it was, but understand that the stock value has lost half its value. On the other hand, if the stock had rallied to 200, doubled from 100, the dividend yield would be 5 divided by 200, which is 2.5%. So this is a very early warning, I suppose, that chasing yield in and of itself can be a dangerous thing because it may hide the truth about the quality of the company, whether it's truly a viable or worthwhile investment for you. But let's talk about shareholder yield. Shareholder yield is defined as cash dividends plus net share repurchases plus net debt paydown, net buy down of debt. All that divided by the market capitalization of the company is a shareholder yield. I wanted to introduce this concept that maybe isn't familiar to a lot of people, and it's, again, shareholder yield. It's maybe a broader form of yield than just simply dividend yield alone. Dividends are one part of shareholder yield. A couple other concepts I want to talk about as relates to dividend. First one is what's called the payout ratio. Basically, a payout ratio is just simply the percentage of net earnings that a company decides to pay out in the form of cash dividend. If a company chooses to pay too high a payout ratio, essentially most of their net cash, it can be a sign of things being too good to be true, because the first sign of weakness in that company or the broader economy may cut into that company's profits and may force that company to reduce its dividend. Empirically, we can go back and look at companies, and usually a high payout ratio is sometimes a warning sign, because it's an example of a company that perhaps is looking short term to appeal to shareholders, maybe post a nice juicy dividend just for optics, but one that's not likely sustainable because of the vagaries of the net earnings, the profits that are needed to actually fund that dividend. The other thing I want to talk about is the concept of an ex-dividend date. Most companies pay dividends quarterly, and there is a date on the calendar that is called the ex-dividend date. This is the date within a given quarter that you have to own the stock prior to that date. So up until just prior to the ex-dividend date. So if the ex-dividend date is on March 12th, let's say, for example, you have to own that stock no later than March 10th to be eligible to get that dividend for the quarter. It's called the date of record. Now, many people think, geez, I'm going to wait till the last minute, buy that stock on the day before the ex-dividend date, and I'm going to get this windfall dividend. That is very, very improper and naive thinking, because actually on the ex-dividend date, most stocks will trade down, all else being equal, the same exact amount of the dividend. So there's no free lunch here. All else being equal, a stock that's going to pay $1 dividend will trade down $1 per share on the ex-dividend date. So no free lunch here on trying to time the purchase of dividend stocks relative to their ex-dividend date. So I'd like to work through some hypothetical questions and illumination of some maybe misconceptions, even mistruths when it comes to dividend investing. So the first question, of course, performance is one thing we should be thinking about. People invest hopefully to have good, solid, risk-adjusted performance. So if we look over a long period of time at dividend stocks compared to other types of stocks, over long periods of time, they have actually done quite a good job at balancing volatility of risk and return. But I'm going to let you in on a secret. There's a class of stocks that have done even better than dividend stocks. All to say that dividend stocks can be great, very good component of a portfolio. They are not the be-all and end-all, and there are other areas that can actually be better, and certainly in the context of a diversified portfolio. So this is a chart that shows a scatter plot of different types of stock classes as a relation between their annualized standard deviation, a measure of volatility, and their annualized total return. This is looking at the Russell 1000 equal weighted universe, and for a period of essentially the end of 1984 to the end of 1921. So the first thing, this axis here, the x-axis, is the annualized standard deviation. If there's one kind of ideal rule in investing, is you want to kind of get the most amount of return for the least amount of volatility. On this axis, as you go further to the right, you get stocks that are more volatile. They've got higher standard deviations. By itself, that's not a good thing. You want to minimize, all else being equal, the standard deviation. On the vertical axis here, you have the annualized total return. And as you go higher, of course, the return goes higher. So generally speaking, you want to look for investment types that are kind of up in this upper quadrant here. Lower on the standard deviation scale, higher on the return scale. So let's look at the universe of the Russell 1000 right here, equal weighted. It's right here. Now notice non-dividend payers have lower return over this period of time, have had. So you look at the non-dividend payers, they have lower return than just the Russell 1000 equal weighted, and quite a bit higher annualized volatility. Just categorically, you might say that's not a good looking thing. On the other hand, you have dividend payers right here, and even perhaps better, dividend growers. These are companies that not only pay dividends, but have shown a consistent track record of increasing those dividends over time. So both of those categories of dividend stocks have somewhat higher returns than just the broad universe, with measurably lower risk. That's a good thing. But here's the secret. We've talked about shareholder yield, which is a concept of not just dividends, but perhaps the election of paying down debt or doing share buybacks. And you can see here, positive shareholder yielders have actually done quite a bit better and for roughly about the same amount of risk. So this would speak to an area where perhaps even more so than just simply dividend payers deserves the most attention. I will point out that this is over a long period of time, buy and hold period. And I'll also point out that the universe has some dividend payers. For example, this is the Russell 1000, but if you look at the S&P 500 index here in November of 2024, over 75% of the stocks in the S&P 500 index pay dividends. So you don't have to chase investment vehicles that have the word yield or dividend in their name to get access to dividend paying stocks. So secret is dividend payers traditionally been quite good balancers of risk return, but even perhaps more impressive is shareholder yields. So the next concept I'd like to talk about is the idea of dividends as a source of safety. Many people are led to believe that just because a stock pays a dividend, it provides a really sound and healthy buffer against potential volatility or downside action in stocks. That just simply is not true. Broadly speaking, to make that assumption would be really at odds with history. And like with any kind of stock investment, whether it's dividend payer or not, is the market fairly valued? Is it overvalued? Is it undervalued? Sometimes we're absolutely in bubble valuations. And here I sit here in early November of 2024, and we have several common valuation metrics for the US stock market that indicate objectively we have never been this overvalued in all of history, not even right before the Great Depression, not even at the tippity top of the tech bubble. So like one very simple valuation metric is the so-called Buffett indicator, Warren Buffett indicator. He was famously asked, there was one indicator he would look at to determine in a glance whether the market was over or undervalued. He basically said, well, look at the valuation of the stock market relative to the economy, GDP. And he said, once that ratio gets over about a 1-to-1, 100%, he starts to get concerned. Well, here we are today, and that ratio is higher than it's ever been. It's 200%. And it's probably no surprise that Warren Buffett's Berkshire Hathaway has amassed its largest cash hoard ever. It's fair to ask, with any stock investing, including dividends, is the valuation environment conducive to good solid returns? A chart here that goes from just before the peak in the market of 2007 out through December 31st of 2012. And the market bottomed in early March. But I've got three different ETFs here. One is just the S&P 500 index, SPY. But then I've got a couple of dividend-focused ETFs. So I've plotted the total return for each of these vehicles. So the Vanguard High Dividend ETF focuses on stocks with high dividends. And this chart is not a return chart, but it's a drawdown from peak chart. It shows the percentage drawdown total return. This includes dividend and price performance of these vehicles from October of 2007 to early March. Every one of these, including the dividend ones, lost well over 50%, approaching 60%. In fact, if you had zoomed in really close here, you'd see that the dividend ones were every bit as bad performing, if not worse, than the S&P 500 index. And then it took many, many years for all of these to kind of get back to even. And by the end of 2012, you can see that the dividend yielders actually had worse performance cumulatively from a drawdown from peak standpoint than even the S&P 500 itself. So in a word, this is just one very strong example as to why counting on the safety of dividends is really perhaps naive. And if you think about it, say a stock pays a 5% dividend. If a stock drops 60%, it would take 12 years, all else being equal, for that share price decline to be compensated for the dividends. You got to put the dividend into perspective relative to the price declines. Many people will just get shaken out on those kinds of declines, dividend or not. The other concept I want to raise here is that dividends aren't a birthright. As I mentioned, go back to Corporate Finance 101. Dividends require net profits to pay out. Well, actually, there's some behavior. Sometimes companies will take on debt just simply to pay a dividend, which is usually a very, very worrisome and imprudent act on the part of a company. Saudi Aramco, the state-owned oil company in Saudi Arabia, the cash on hand of the company has been greatly diminished, and the company took on a bunch of debt in order to pay its dividend, where a prudent CFO and board of directors would say, you know what, we don't have the profits to pay this dividend. We're going to cut the dividend. It's the right thing to do. So some companies load up on debt to give the illusion of safety and prosperity and paying out a dividend that they really can't afford. Leads me to talking about that dividends are not a birthright. And in fact, when times get tough, what we see historically is companies reduce or even eliminate or put on pause their dividend altogether. So check this graph out. This goes back to 1995 and it goes up through April 8th of 2020. And it just shows a spike in the number of companies announcing dividend cuts within the S&P 500. So you see here in 2000, 2001, the tech bubble, there was a spike in companies cutting their dividend. Big slashes here in 08, 09, the great financial crisis. This is during the COVID plunge here in early 2020. Bottom line is, when this idea that dividends are safety against price declines, it just doesn't hold true in real life, because many of these companies, especially those that have imprudently paid out too high a dividend, are the first ones that are going to have to cut those dividends and take away the very safety that investors are counting on. If dividends can be a good thing, and they no doubt are, they're one of many good things a company can do with their net earnings. But if dividends are a good thing, is more better? Well, the simple, quick answer is no, more is not better. In fact, sometimes less is better. So this is a study that was done by the Hartford Funds, and it looks at breaking the S&P 500 into quintiles by the dividend yield. So the first quintile is the top 20% highest yielding stocks within the S&P 500. And of course, at the other end of the spectrum, the fifth quintile is the lowest 20% stocks in the S&P 500 that pay a dividend or don't pay a dividend at all, because many companies in the S&P 500 don't pay dividends. And then it further breaks it down by decades. This chart vets out some really interesting takeaways. So for example, if we look at the period 1990 through December 1999, the lead up into the internet bubble. So the S&P 500 averaged almost 18% per year annual return. But if you look here, there was almost a direct inverse correlation. In other words, the highest dividend yielders returned lower than the lowest dividend yielders. In fact, the best performing quintile was the fifth quintile here, that paid the lowest, or in fact, many cases, no dividend. The very next decade, in the wake of the tech bubble bursting, the opposite is true. The index itself actually lost value over the following decade, but the higher yielders did relatively better than the lower yielders. And then if we look more recently, the decade from January 2010 to 2019, again, you had, for example, the third and fourth quintile of dividend yielders outperforming the index itself and the top two quintiles. And again, more recently, in the period January 2020 through December 23rd, you've got the fourth quintile, again, amongst the lowest yielders in the S&P 500, outperforming most of the other parts of the market. Bottom line, while dividend stocks can perform quite nicely over long periods of time, there are some parts of the market cycle where they're outright laggards relative to other types of stocks. And it's important to have a dynamic strategy that can tease those trends out. So what if we look more finely in the market complexion and look at it at a sector level? So this is a breakdown of the stock market into the various economic sectors. And what I've done here is I've ranked the sectors by highest yield to lowest yield. And this is as of 12/31/23. So you can see the energy sector at that time had the highest dividend yield, 3.9%. Information technology and consumer discretionary on the other end of the spectrum tied for 10th at just 0.76% yield. In fact, you might throw communications right in the same bucket there. So quite a spread of dividend yields across the sectors. But interestingly, if you look at the total return performance in the 10 months that followed this, through year-to-date 2024 through the end of October, the very highest yielding sector was actually the worst performing from a total return standpoint of all the sectors, the energy sector. Now, the utility sector, which was second in yield, actually has done quite well. It's the highest performing sector as of this time period. So that speaks to dividends in that sector anyways. But some other really interesting things. So for example, the low yielding communications sector was the second best performing sector. Clearly, not just at the market level, but even across sectors, higher is not always better. In fact, sometimes higher is actually the worst in terms of yield. So one of the themes that I like to extract from the data that I've shared so far is simply that when it comes to investing, it's really important to invest in quality and trending stocks, frankly. Oftentimes, simply chasing a yield strategy can lead to what we call yield traps. And that oftentimes leads you down a dark corner of markets. So this analysis that Dorsey Wright compares, so it focuses on a stock, a high yielding stock, AT&T. Many people are familiar with AT&T. Ticker symbol is T. The reason this has T.TR is it's the total return index. It includes not just the share price returns, but also the dividend returns. So this is a chart that goes back to October 26, 2016, right through June 26 of 24. And you can see the AT&T, even including the juicy 6% or so dividend that it paid, was basically a long trip to nowhere. You didn't get much in the way of good performance there because the stock had been a dog. It's actually perked up this year to date since June quite a bit, But over the long expansive history, it was a very underperforming stock. And even despite the rich yield that is historically paid out, it has not been a good overall investment return for clients. Compare that with an ETF that tracks the whole broader communication sector, of which AT&T is part of. There's a ticker symbol ETF XLC. It's a sector spider communications ETF, and that's the black line. Now, this only had a yield in June of 24 of a little over 1%, I believe. So much lower yield. But yet look at the total return of that compared to AT&T. It blew it away, right? Much better performance. And this green line poses the hypothetical, well, if instead of chasing dividend yields, you instead chase strong stocks, whether or not they pay a high yield or not, and simply pay yourself, quote unquote, a dividend by cashing in some of the share price appreciation each year. And that's exactly what this analysis shows. It shows if you had bought XLC and just simply sold down 6% of it year to pay yourself a dividend, you would have done quite a bit better than even owning AT&T. So the key takeaway there is always really important to not become myopic about any one factor. And dividends are one that people have become very myopic about, especially in the decade after the great financial crisis, where the Federal Reserve drove interest rates down to zero. Many folks that used to be content in CDs or bank deposits, attractive, at least fair rates, were forced in their own minds to chase yield. And that has created we think, a bubble in many kind of yielding type of vehicles. And of course, over the last couple of years here, the Federal Reserve has raised interest rates on the short term so that people can get a decent return, even just holding things like treasury bills or money market accounts while being safe with their assets. The Federal Reserve had just started this September of 2024 to start to decline, reduce interest rates. So we're starting to see some fears come in again of people thinking they have to chase yield. And I just wanted to use this example here to really warn about the cautions of chasing yield. So I hope you found this video helpful in explaining what yield dividends are, why they're not the be-all and end-all, why they can be a very important part of a portfolio. They should not be the sole focus. In fact, making them the sole focus can oftentimes lead investors astray. Again, this is the second in a multi-part series on investing for income. The first one I mentioned I did a few weeks ago was on bonds. I'm going to be doing another one in the series. I'll focus specifically in that video on specifically yield type of investments, yield funds. And they entertain a whole host of other considerations and pitfalls that I hope to illuminate in that video. The best way to make sure you get alerted as to when that video, and frankly any video that we do, we put out content every week, is to subscribe to this channel. Hit the subscribe button down below. Like this video, certainly, if you like it. Provide comments and feedback. We always like to hear your comments and feedback, ideas that you'd like us to focus future videos on. Please feel free to share it with your family and friends if you think they will find some benefit in the educational content here. I want to thank you again for watching. Until next time, I want to wish you a great day.